we learned about some things. We look at the introduction to the forex market, and then what forex is, the participants in the forex market, and then what is traded in the market. And then we said what is traded is we trade currencies, not any other thing. In the forex market, we trade only currencies. And then we look at some of the advantages of forex market, and then we move on by looking at the trading times and then sections. And then we talk about the three main trading times and then sections, which are the Asian, London, and then New York. And then we continue the trading sections opening and closing time. We look at that one to the best sessions to trade, the best days to trade forex, and then which we said Tuesdays, Wednesdays, and Thursday. And then I gave the reasons why these days are the best days to trade forex. And then we look at forex broker, what brokers are, and then what to look out for before going in for a good broker. And then we end here looking at the terminologies used in forex. And I said these are the forex jargons that we looked at yesterday before we end our class. So today we'll continue from this point, the different currencies and currency pairs. In forex, currencies are traded in pairs. The first currency is called the base currency, and the second currency is called the quote currency. I think that one is clear. That in forex currencies, we can't trade just one currency. We can't trade only the US dollar. So currencies we trade them in pairs. We trade them, they move together. I said yesterday that forex trading is just like how you go to the forex brewery and then you exchange your money. As in, like when you want to move into a different country, say you are moving from Ghana to USA, you need to change your Ghana cedis into the US dollar. So you doing that transaction, that is forex trading. It's happening between two currencies. So that's the same thing we do here, but we do it digital. So currencies, we trade them in pairs. And then the first one is always the base currency, whilst the second one is the quote currency. So for example, we have the euro US dollar, and then the euro here is the base currency, whilst the US dollar is the quote currency. Okay, so from there are strong economies that play major roles in the forex market. Whenever these economies are in play, things in the market begins to turn massively. Volatility begins to play well. So we have some major economies that play strong roles in the market. So we have the euro, that is represented with the EUR, that's the euro. We have that economy, and then we have the USD, that is for the United States people, and it's represented with the USD, that's the US dollar. And then we have the GBP, that's the Great British Pound for the Britons. And then we have the CHF, the Swiss francs. And we have the NZD, New Zealand dollar. For the New Zealand people, we have the AUD, that is Australian dollar. And then we have the CAD, we have Canadian dollar. We have JPY, that is Japanese yen, JPY, Japanese yen. So these 8 economies, they play strong roles in the forex market. These 8, please note this. We have 8 strong economies that play strong role in the forex market. Okay, so our next topic is a type of currency pairs. So please, if you are writing, just follow me back to back. Type of currency pairs. We have the major currency pairs, we have the minor currency pairs, and then we have the exotic currency pairs. I take it again. We have the major, we have the minor, and then we have the exotic. So first, let's look at the major pairs. We have 7 major pairs. 7 major pairs. When it comes to forex, we have 7 major pairs. Okay, so let me show you one trick to get all these 7 major pairs. Kindly pay attention to this place well. Okay, so I said we have 7 major currency pairs in Forex. So what I advise you to know now is to just know the 8 strong economies. We have the Euro, we have the USD, we have the GBP, we have the CHF, NZD, AUD, CAD2, JPY. They are the 8. So for you to know the major pairs, just take out the US dollar and then match it with the rest. You take out the US dollar and then you match it with the rest. But you don't match it anyhow. You are going to look at how it is being matched. Just take out the US dollar and then it will go with all of them. So let's look at it again. Okay, so for the major pairs, we have the Euro US dollar, we have the Pound US dollar, we have the Aussie dollar, that is AUD USD, and then we have the NZD USD. Another name is Kiwi dollar. We have USD CHF. Another name is dollar Swiss. We have the USD CAD. Another name is dollar Luni. We have the USD JPY. Another name is dollar Yen. So please, if you are taking notes, please be fast. Just follow me back to back. So if you look in all these major pairs, we have the USD paired with all of them. The USD is playing part in all these pairs, all the major pairs. The Euro is going with USD up to the USD JPY. They all have USD in them. So look at this well. Look at the major pairs well. Please look at them well. Okay, so the minor pairs. So these are pairs that do not have USD element to it. Like they do not have USD element in them. So all the other pairs, they are the minor pairs. For example, we have the Euro crosses. Thus, we have the Euro CHF, we have the Euro GBP, we have the Euro CAD. And then another example, we have the Yen crosses. That is the JPY crosses. We have CAD JPY, we have AUD JPY, we have NZD JPY. And then we have the Pound crosses. We have the GBP AUD, we have the GBP CAD, we have the GBP NZD. Okay, so you may ask me, why is it that? Is there any special arrangement? This is how it is. This is how the arrangement is. So you have to open your eyes and know how these pairs are being arranged. You can't say CHF Euro. No. There is nothing like CHF Euro. We have Euro CHF. So just open your eyes and grab these things well. I hope I'm making sense. The exotic pairs. Okay, these are pairs that are scarcely traded. For example, okay, so let me explain. For exotic pairs, they are economies that they have the USD crosses, but they are not among the 8 strong economies. They are all these economies that we have, that they have the USD attached to them, but they are not part of that 8 strong economies. They are the exotic, but they have USD attached to them. For example, we have the USD ZAR. That is for the South African, the ZAR, the USD ZAR, and then we have the USD MXN, which is for the Mexican, and then we have the USD TRY, that is for the Turkish. So, and then let's say, for example, USD Ghana cedis. That one is also an exotic pair. I hope I'm making sense. USD Naira. That one is also an exotic pair. So all the rest that are having USD in them, they are all exotic because they are not part of the strong economy. The 8 strong economy that I told you about, they are not part. So they are all exotic. Okay, so we are going to look at what leverage is. Yesterday, when I was talking about the jargons, we mentioned something like leverage. That one was part of the jargons that I mentioned yesterday. So we are going to look at what leverage is. When we talk about leverage, what leverage is. Okay, so explaining leverage is just like a money that your broker will borrow to you. I said in those days, yesterday, I said that in those days, retailers were not allowed to trade Forex. Why? Because the money that is being involved is too much. But right now, we have brokers that they can borrow you money. They can lend you money. But this, you can't see it with your physical eye. They do it at their end. So this is what we call leverage. So it's the ability to use something small to control something big. So you are using something small to control something big. In the case of Forex, using a small capital base to control a large lot size. Yes, that is it. The principle of leverage is virtually multiplying that your little capital so that you can use it to buy something worth a bigger value. For example, when you are creating your account and then you want to deposit, during the process, they will ask you to choose a leverage. And then these are some of the examples of the leverage. We have 1:100, we have 1:500, we have 1:1000, then etc. More. We have more. Okay. But there is one thing about leverage. Leverage is like a two-edged sword. Leverage can make your profit to appreciate quick, choosing a bigger leverage. That is the same way if the trade is going against you. That same leverage can cause you to lose heavily. So that is about leverage. The leverage I advise is 1:500 for account of $100 or anything lower than $100 to $1,000. 1:500 is good to go. You are good to go with that one. So please take note of that. Okay, so how to calculate leverage? If you have 100 USD and you choose a leverage of 1:10, the leverage here is calculated by multiplying the 100 USD by 10. Please, am I making sense? Okay, meaning you can control 10 times your initial capital, which is 1,000 USD. If you are being given a leverage of 1:10 and then you have equity of 100 USD, that is, you are going to multiply that leverage, that 10, with that your equity, and then that will give you 1,000. So meaning you are trading 1,000 USD, but it won't show. The brokers, they will do it at their end. If you have $500 to trade with, and then you are choosing a leverage of 1:10, that means at the back office of the brokers will multiply 10 with that $500. You get me? So that will give you 5,000. So meaning you are trading 5,000, like worth 5,000. So you can open a lot that will carry like 5,000. Okay, if you have 50 USD in your account, $50 in your account, your broker will never allow you to place a lot that is 1.00 lot. Your broker will never allow you, but with the help of leverage, you can. Because you can choose leverage of 1:2,000, meaning you are not trading your $50 again. You are multiplying your $50 times the 2,000. That is what you are trading. So you can open big lot and go in big. Maybe you are seeing a color move and then you want to take advantage of it and then double something up. You just want to rig something on board. You can just deposit, let's say $100, and then like you choose leverage of 1:2,000, and then you go all in hard on it. But with that $100, your broker will never allow you to open a lot of one lot. They will never allow you. So it is the leverage that will give you space to open some lots. Your lot will determine the profit you make. Your lot plus your pip movement will determine the profit that you make. Please, am I making sense? The Forex lot size. So I was talking about lots. Lot is just like the money you are putting in. So just grab that in your mind. The money I'm putting into the trade. That is lot size. So for the lot size, we have standard lot, we have mini lot, we have micro lot, we have nano lot. And then we have the units. We have the 100,000 units, we have the 10,000 units, we have the 1,000 units, we have 100 units. The volume for 100,000 units, we have 1.00. That is the one lot. And then per pip movement, with that, one pip movement will give you $10. For the mini lot, that is the 10,000 units. That is 0.10. Per pip movement, that is $1. For the micro lot, that is 1,000 units. That is 0.01. Per pip movement, that is 0.10 cents. Okay, so with the nano lot, the unit is 100 and then the volume is 0.001. So per pip movement, that is what you get, 0.01 cents. So anytime you are using one lot, that is 1.00 per pip movement. One pip is $10. 2 pips will be $20. 3 pips will be $30. 4 pips will be $40. And then the same with 0.1. If you are using 0.1 as lot size, per pip movement, 1 pip is $1. 2 pip is $2. 3 pips is $3. If you are using 0.01, per pip movement, 0.10 to 0.10 cents. Okay, so let's move to the next one. Okay, pip, that is point in percentage. The P stands for point, I in, the other P, percentage. That is pip, the smallest price movement in a currency pair. Okay, so I said something yesterday that in economics we don't call it pip, we call it price. So it's just the same thing. So technically we call it pips, but when it comes to economics, you call it price movement. So in economics is price movement, and then technically is pip movement. Okay, so let's move on and see. Okay, so how to calculate pip movement? For most currency pairs like the major and crosses, we consider the fourth decimal place. Okay, so for most currency pairs like the major, we have 7 major which we talked about. We consider the fourth decimal place. Okay, so we have an example here, the Euro US dollar. For example, say Euro US dollar is trading at 1.2511. If Euro US dollar move 2 pips up, whenever it is going up, we are adding. Whenever it is coming down, we are subtracting. Upwards movement, I said yesterday that it is bullish or buying. So whenever we are going up, we are adding. Whenever we are coming down, we are subtracting. So should Euro move from 1.2511 2 pip upwards, we consider the fourth decimal place. So that is where the calculation starts from. We consider the fourth decimal point. That is where the calculation starts from. Okay, so please look at the pip calculation well. I'm going to explain it and then explain it well so that you can understand. 1.2511. Okay. So we have 1.2511. So if you want to calculate the pip movement for this, you consider the fourth decimal place. That is, this is 1, this is 2, this is 3, this is 4. So this is the fourth one. So we consider here. So we are saying Euro USD move 2 pips. So meaning we will add 2 to this last one. The fourth decimal place here. You will add 2 to it. Okay, so let me go over again. I said Euro is trading at 2 5 1 1. So if euro move 2 pips up, meaning we are adding, we consider the fourth decimal place. So this is the 1, 2, 3, and this is the fourth one. So we consider this one. So we will add 2 to the 1. So that will be 1.2513. So that is it. With this same example, 1.2511, should euro move to the upside 10 pips, what will be the answer? Okay. So let's do it together. Let's do it together. Okay. So we have 1.2511 moving up 10 times, like 10 pips to the upside. Okay, so we are just going to add the 10. If we add the 10 to this one, that will give us 11. If we add the 10 to the last fourth decimal place, that will give us 11. So you just pick one, you add it to this, and that will give us 1.2521. That is it. So adding 10 to this, moving up, we have we consider the fourth decimal place. So if you add 10 to this, it will give you 11. We are counting to the upside. So that 11, you remove one and then we add it to this one here. So this one will become 2, and then the rest of the one we just put it here. Or better still, if you want to be smart, this 11, you just add 10 to it. That is it. You just add 10 to it. Okay, so the number 2 is 2 pips down, like to the downside. I let you know that anytime we are coming down, we are subtracting. Anytime we are going up, we are adding. So the same number, 1.2511. If we are coming down, meaning we are going to subtract 2. So looking at the 1.2511, the last one, we can't subtract 2 from that one. The last, considering the fourth decimal place, we can't subtract 2 from that one. So we need to consider the 11. So now we subtract from the 11. So that becomes 1.2509. When it comes to gold, so many people trade gold, but the pip calculation for gold is different from that of the major pairs and then that one. So after that, we move on, and then for JPY pairs, it is different. But let's deal with this one first before we move on to the JPY pairs. We were talking about 1.2511, right? What was our distance? We have 1.2511. Okay. For Euro USD. So this Euro USD here, and then this is my white line here. So this is 1.2511. We consider the fourth decimal places. You can see 1.251100000000, but we consider the fourth decimal place. So the fourth decimal place is where the last one is, 1.2511. So moving up 2 pips, we did the calculation. So that one should be 1.25130. So that will be 1.2513, the fourth decimal place. You see so many zeros, like you can add so many zeros to it, but we consider the fourth decimal place, only the fourth decimal place. So let's calculate and see from here to here. Let's see the movement. And then that's the example that I gave to. I can prove it to you and then you see it. Okay, so this is my ruler. Let's calculate from here to here. Can you see 2.0 at the end? 2.0. That is the pip. So meaning that is 2 pips up movement. You get me? 2.0. Yeah. So that is it. And then with the example that we look at, we had our answer to be 1.2521, right? 1.2521. So let me prove that to you. 1.25. Okay, so let me prove it to you. We said to the upside 10 pips to the upside. Okay, so calculating from here back to the upside. Can you all see 10.0 from the down to that top where the 1.2521000 is? Can you all see? So that is how we calculate pips. So please take note of this. This pip calculation for the major and then the minus. Okay, so for JPY, that is the yen. First, we consider the second digit after the decimal point. It's just the same thing, but for the JPY pairs, that is Euro JPY, Euro AUD JPY, all those JPY pairs, we consider the second one after the decimal point. That is where your calculation starts from. The second one after the decimal point. Please, am I making sense? The second one after the decimal point. So, for example, we have Euro JPY at 120.10. So, to the 5 pips up. So, that will be 120.1 into bracket, then you add the 5 to that last 0. That is the second decimal place. So you add the 5 to that last 0. So that will give you the final answer will be 120.15. That is it. For the JPY pairs, we consider the second decimal point, 1 and then 2. Okay, so the second one, which is coming down, when it's coming down, we subtract. Okay, so for the Euro JPY, when it's coming down, that will give us 120 points, and then we subtract the 5 from that 10. Okay, so our final answer will be 120.05, because 5 minus 10 will give you 5, so 0.5. Okay, so let's look at these ones. We have bid and ask. So for the bid price, they are also part of the jargons. The price at which you sell. The broker will give you to sell at this price. That is the price your broker will give you. You get me? To sell at. Please look at this word. This thing confuses a whole lot of people. So the bid price, the price. You can search on Google bid and ask price in Forex. Don't leave it open. Bid and ask price in Forex trading. And then they will give it to you. You will see it. The price at which you can sell at. This is in Forex. That is the price your broker will give you to sell at. And then the ask is the opposite. The price that your broker will give you to buy at. Whenever you are trading, there is always a bid and then ask price given. And your choice will be made depending on the direction you want. Okay, so for example, we have 1.200/1.2003. So the bid price is the 1.2001, and then the ask price is the 1.2003. Why? The higher value is always the ask price. Please take note of that. The higher value, it is always the ask price. Okay, so when you look at the ask price, you can see there are some difference there. We've just learned about pip calculation. You can see there is some difference of 2 there. Just looking with your eyes from 1 to 3. That difference is what we call spread. So the brokers, they make money out from spread. The brokers, they are not there to make money. That is not the agenda for them to make money from your losses. They are into business to make money from spread, but if you lose, they will take that money too. So that is what we call spread. Spread. So this is spread. The difference between the ask and then the bid price, that is the bid ask spread. For example, the difference between those two is 2. Those two numbers is 2 pips. So the spread is 2. So whenever you see that, meaning your broker is charging you 2 pips. So let's quickly check on Google and see something. Let me show you something, how you see it. Okay, so for example, when you come here, you see that we have bid price here, and then we have the ask price here. And then we said the ask price is always the higher value. And then when you check here, you see there is a pip difference here. So your spread tends to be 1 pip in this scenario. Okay. And then I said earlier on that your bid price, that is the price your broker will give you to sell at. So you can see this one, this blue line here. So this is the price your broker is giving you. So when you open it, you'll be seeing some zigzag. So this one, that is your bid. That is all your broker is giving you to sell at. Whenever you sell here, for price to the difference, you see this gap here, the gap between these 2 lines, the red, that is where the spread is. So they make money from this gap movement. So when you sell here, meaning you are expecting price to go down. So for this thing to come and cross your position, they have already making their money. So they make money out from like this place. We call here spread. The open here is spread. Okay, so talking about spread is the difference between the bid and then the ask price. That is what we call spread. So looking here, we learned about pip calculation. So comparing these two, the difference here should be just 1. We have 1 there. That is 1 pip. And then we have some pipette on it, but let's forget about the pipette. Let's focus on only the pip. So we have 1 pip movement here. So that becomes our spread. And then I said the bid is the price your broker will give you to sell at. Because the bid price for broker A is different from the bid price of broker B. There is a slight difference. That's just something small. So this is your bid price that the broker is giving you, and then this is your ask. So the difference between this and this, which is the one that we are having, that is what we call the spread. So you see a whole lot of people saying that, my broker is charging me big spread. Oh, big spread. This is what they are talking about. So when you are looking out for a broker to choose a good broker, you have to check whether they have tight spread. Tight spread means they don't charge you much. Like they charge max should be 2 pips. Sometimes it's not even up to 1 pip. Just some pipettes. That is all. Just some pipettes. That is all. We are good. Okay. So thank you all for joining the call, and then see you tomorrow same time. Bye bye. Tell a friend to tell another friend. Bye bye.